Good afternoon, everyone, and welcome to Protecting 50 Plus Investors Through Behavioral Insights. My name is Mary Varakis, Program Manager for Programs for 50 Plus and Community Engagement at the Chang School. Before we get started, I would like to acknowledge the land on which Ryerson University is built upon. Toronto is in the Dish with One Spoon territory. The Dish with One Spoon is a treaty between the Anishinaabe, the Mississaugas, and the Haudenosaunee that bound them to share the territory and protect the land. Subsequent Indigenous nations and peoples, Europeans, and all newcomers have been invited into this treaty in the spirit of peace, friendship, and respect. Now, I'd like to go over just a few items on how to participate for today's workshop. Please ensure your microphone is muted so as not to disturb other attendees and the presenters of the workshop this afternoon. Please refrain from having your video on. However, if you do choose to have it on, please be mindful of your actions as your camera is visible to everyone at today's workshop. For the hearing impaired, we also have automated captioning available today, which you can access by activating the toolbar. It's located at the bottom of your screen. You will have an opportunity to submit text questions to today's presenters by typing your questions in the chat box, which is located in the control panel. It should be at the right-hand side of your screens. You can send in your questions when prompted by the presenters during the Q&A session, which we're going to hold at the end of today's presentation. Please note that the opinions expressed today in this event by our speakers do not express the views or opinions of Ryerson University. The information presented in this workshop is provided for general information purposes only. I would now like to introduce our guest speakers, Christine Allam and Michael Tracy, for today's workshop. First, Christine will be presenting. Christine Allam is Senior Advisor, Investor Engagement and Stakeholder Partnerships in the Investor Office of the Ontario Securities Commission, where she partners with various groups and organizations to deliver investor education and fraud prevention workshops. Prior to joining the OSC, she worked at the Toronto Stock Exchange. Her financial expertise includes adult training, curriculum resource development, relationship management, and community outreach. Christine has graduated from Ryerson University. Our second presenter today will be Michael Tracy. Michael Tracy is the Senior Advisor Behavioural Insights at the Ontario Securities Commission. He's an experienced research professional who has worked in the areas of economic consulting, not-for-profit research, and university research. His research interests include behavioral economics and policy innovation. Michael holds an MA from the University of Windsor and is pursuing an Executive Master's of Science in Behavioral Science from the London School of Economics. Welcome, Christine and Michael. It's great to have you with us this afternoon.
Thank you for that, Mary. Well, hello, everyone. So nice to see so many people joining us today to hear about what we are doing to help you protect yourself from fraud and also to help you make more informed financial decisions. So as Mary mentioned, my name is Christine, and I'll give you a quick introduction on the OSC, the Ontario Securities Commission. I'll also share a little bit about what's happening in the world of fraud. And then my colleague Michael will talk to you about what we are doing to help you using behavioral insights. So as mentioned, I work for the Ontario Securities Commission, and we are the government agency that regulates the capital market in Ontario. So as a regulator, a key part of our mandate is to provide protection to investors. And one of the best ways to do that is to ensure that you have good information so that you can make more informed financial decisions for yourself. I work for the Investor Office. That's a branch within the OSC. And within the Investor Office, we have community outreach, doing presentations like this as part of our outreach program. We also have a research team, which Mike heads up, and you will hear from him. We also have an education team where we develop resources, and we also have a policy team where when you ask questions, the questions that you ask or comments that you share with us. Those things may be of interest to our policy team as we're developing policy. So it's nice that we are able to share information with you, and we also take information from you through your feedback. So in a nutshell, that's what we do at USC. Now, a lot of what we're doing is also driven and backed by research. We've been living in the world of COVID-19 for the past 15 months, and hopefully we're getting through that. But when we've been in this pandemic, we've done some research, and research showed us that, 31% of Canadians are not prepared for financial emergency. And that's a third of us. And that's quite scary. We also know that, people believe that their investments have been negative, have had a negative impact based on what's been happening. So, one of the things we also see is a large increase in fraud. And one of the things we know is that 1 in 2 victims of investment fraud are 55 and over. So what are we doing, and what do we know about fraud? So what I will tell you is that 1 in 25 Canadians say that they've been a victim of investment fraud. 1 in 5 of us will be approached to take part in a fraudulent scheme. But only 1 in 3 of us will ever report it. We also know fraud is an underreported crime. In my role where I have gone out and I've shared information about fraud prevention, people will tell me how they were the victim of a fraud. And many times if I ask, did you report it? The answer is no. And why is that? They're embarrassed. They don't want family and friends to know. They tell me that they don't want to look stupid. And I'm going to tell you right now, anyone can be the victim of fraud. Fraudsters, all they care about is getting access to your money. So we're also living in world of COVID-19, and we are seeing what we are calling COVID-19 related frauds. Now, these are not new frauds, but again, these are fraudsters who are taking advantage of this pandemic because they know, what, you and I are concerned about our health, we're concerned about our finances. And knowing that we're concerned, they've taken some of these frauds and put the little COVID-19 spin on it or applied it to the pandemic to get us to either share information with them that they can use for their benefit, or get us to part with our money. And some of these frauds you're well aware of, like warning about your finances, right? So they pretend to be from a financial institution and they want information from you. Similarly, they pretend to be from a government agency, and they're going to help you get some of these wonderful support programs that have been put in place to help Canadians. Again, it's fraudsters. They're also posing as employers. You know what? Many people are unemployed right now, or they're working reduced hours. So what are they looking for? They're looking for ways to earn or supplement income. And they're saying, you know what? You can work from home. One of the jobs that they're saying you can do from home is trade in securities, and you don't need a license or any qualifications. I need to right now, if you want to work in the securities industry, you want to trade investments from home, you need to be registered with the Securities Commission. So these are just some of the COVID-19 related frauds that we're seeing. What else are we seeing? This is an investment type fraud, but again, they've used that COVID-19 situation to their advantage, the pump and dump. How does the pump and dump work? Fraudster has a bunch of worthless stock. And what they do is they write some very positive, glowing articles about that company. And then they get a bunch of people, call you up to promote the stock, tell you to buy it right now. Because if you look at the news, you look at the website, you'll see that this company is doing so well and the stock is selling at a really low price. So you should buy it because you know what? The stock price will only go up and you'll make lots of money. So what are the fraudsters saying right now? They're selling stocks that are providing a product or service that can help with COVID-19. And the latest pump and dump I read about, these fraudsters were selling COVID-19 vaccination kits. Well, you know what? We know we don't need vaccination kits because Government of Canada has approved vaccines for all Canadians, and they're making it freely available. But remember, these are fraudsters, right? They're just taking advantage of that situation to try and sell us these worthless stock. You buy the stock, they disappear, you're still left holding worthless stock. So another type of fraud that we're seeing is the affinity fraud. And what's affinity fraud? That's one where fraudsters target groups of people that share a common interest or maybe a common identity. Common identity could be the same cultural group, maybe you share the same faith, same religion, or you have a common interest. Maybe you like to, you know, socialize, so you're part of a social club. Maybe you like to, you know, learn about new things, so you're part of a group that attends a lot of workshops. However it works, these fraudsters targets these particular groups, not because they share that same interest. They target these groups because what they want to do is develop a relationship with members of the group. Once they feel that you have, or that they have a strong relationship with the group, what do? They tell you that they have a way that they can, you know, help you make money. And because this is someone that you've they've, you know, been in your group, you've gotten to know them, they've gotten to know you, you are likely, you know, going to listen to them and say, yeah, you know what, I'll take part in that wonderful opportunity that's going to help me make money. What happens as soon as one person in the group participates, likely the rest of the group will also participate. Fraudster now has all your money, and guess what? They drop out of the group and they disappear, and now you're the victim of an affinity fraud. Another one we're seeing, and you know, I've been reading about this one a few times now in the news lately, is the Ponzi scheme. And you may even be aware of the Ponzi scheme. But again, these are fraudsters, right? So they're going to use everything to their advantage. So how does a Ponzi scheme work? Well, if I'm the fraudster, I say to you, you know what? It's a really low interest rate environment. Don't put your money in the bank because you know you're not going to get anything. Give me your money. Let me invest it for you. I can promise you high returns, no risk. And that's what I do. I go out and I recruit people to give me money. Now, the first group of people that I took money from, guess what? They're saying to me, Christine, I have not seen any of that high returns that you've promised. And I say to them, you know what? You are making over 25%. Leave that money, let it work, let it grow. And some of you will say yes. And some of you will say, no, 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 I need to see that interest payment. I need to see those returns. So for those that want to see their returns, what I say is, don't worry, I will get you your returns. So what do? I go out, I recruit another bunch of people, take money from them, and I take that money and I share it with that first group. And that's how a Ponzi scheme works. I take money from the new people and I share it with those that I had recruited earlier. What do I do with the money? I live a wonderful life. I live in nice homes. I take wonderful vacations. Now, as a fraudster, and for the scheme to work, I have to keep bringing in more and more people into the scheme. When the group gets too large for me to manage, I have to remember who's new, who I've paid, who I've not paid. What am I going to do? I'm going to walk away and let the group collapse. So once that collapses, you've now been the victim of a Ponzi scheme. Another one that we see, you know, is the double dip repeat scam. If you've been the victim of a fraud, there's a very good chance you can become a repeat victim. And people have said to me, no way, if I've lost money once, there's no way I'm going to lose money a second time. 3 out of 10 victims are defrauded more than once. So how can it work? Think back to that Ponzi scheme. I've defrauded you. I cannot come back and defraud you a second time. But I have something very valuable. That's your names and your contact information. So what do I do with that? I go look for my fellow fraudster, because I know my fellow fraudster might be interested in buying my list, or maybe they have a list. And if they have a list, maybe we exchange list. However it works, this new fraudster now has your names. So what do? Call you up. Oh, hello, I understand you were defrauded by Christine. There's a whole group of us that was defrauded. We're banding together to hire a lawyer to try and get as much money back as possible and hopefully take Chris to court. So we're reaching out to as many people as that we know that we believe were victimized by Christine. You're thinking, yep, I lost money. I want to participate. And then the person says, and all we're asking for is contribution toward the legal fees. And you're like, I'm in. you have now become the victim of a double dip. Another way that this works is that they can say to you, you know what, guess what? Um, you've lost all this money. If you just invest a little bit more, you can make your original investment back. Okay, different ways that these fraudsters will try and just defraud you a second time to just try and get some of your money. And then there are other types of investment scams out there. Forex, foreign exchange currency scam, offshore investing. They tell you move your money outside of Canada. And you know what? Once you move it outside of Canada, now you're outside of our jurisdiction. Exempt securities where you need to meet a certain financial threshold before you can participate in certain investments. Then there are companies or fraudsters who are saying, you know what? They're selling these products and they're claiming that it's under some well-known brand where it's not, because that company is not offering these products, but fraudsters are doing that. Or they're saying that, you know what, these fraudsters, their company is accredited to do certain things, and that's not true either. So lots of different types of frauds out there. But how would you know an opportunity is not such a good opportunity? What are some of the warning signs? So high pressure sales tactics. Have I got a deal for you? I'm a fraudster. I want you to act right away. So I'm going to use high pressure sales tactics. You know what? I need your answer by 1:30. I don't want you to think about the deal. So somebody pressuring you to act right away, walk away. No deal is so good that you need to act right on the spot. And then something we're all very familiar with. Phone calls, emails, text messages from people we don't know offering us wonderful opportunities. Someone contacts us and offers us a wonderful opportunity, should raise a big red flag. Because I don't know you, you don't know me. If I'm contacting you about a wonderful opportunity, your question to yourself should be, why are they contacting me? What's in it for them? How do they benefit? So when you get these kinds of calls and emails and text messages, delete, ignore. It's in your best interest to not respond. Free incentives is another warning sign. I love getting free stuff. But if somebody's giving me a weekend away for free, likely they want something in return. And then remember my Ponzi example, promises of higher guaranteed returns with little to no risk. If you invest, the higher risk the investment, the likelihood you could make higher returns. But remember, likelihood you could also lose everything, right? Because it's higher risk. So promises of higher guaranteed returns with little to no risk, not true. Then encourage to recruit family and friends. I say to you, I've got a wonderful deal. Then the next words out of my mouth, do you have family and friends that might want to participate? Am I really offering you something that is to your benefit, or am I looking to get more and more people to participate in something that might not be such a good opportunity? Another warning sign is dealing with someone that is not registered. If you are working with someone who's helping you manage your investments, you're getting investment advice, they're selling you investments, this individual, this firm, must be registered with the Securities Commission. So make sure that you're dealing with someone that is registered. Another warning sign is someone suggests you falsify financial information. There are certain investment opportunities out there where if you are an accredited investor, you meet a certain financial threshold, you can participate. Well, sometimes they tell you that they will make an exception for you. You don't need to meet that financial threshold, and they ask you to falsify financial information. Big red flag, big warning sign. This person not acting in your best interest, they're not giving you good advice. Like they're suggesting that you falsify financial information. Another warning sign is a tax avoidance strategy. There are plans out there, there are programs out there that can help us minimize the amount of taxes we pay, that can help us be more tax efficient. There are no plans out there that can help us avoid paying taxes. So be very wary when somebody's promising to help you avoid paying taxes. And the very last warning sign is acting on inside information or hot scoop. If I say to you, I have a hot tip, I have some inside information, am I sharing that information with you? Illegal. You're acting on that information? Also illegal. So what do we want you to do? We want you to protect yourself. Be skeptical. If someone approaches you and offers you an unsolicited investment opportunity, Be very skeptical. Question that. If it's something you're interested in, get a second opinion before you invest. Ask for a second opinion from a qualified individual, like a registered advisor, a lawyer, or an accountant. Take the time you need. Don't let anyone pressure you into acting and signing on the dotted line. There is no deal that is so good you would have to act right on the spot. And always, always do your homework. Understand what you're investing in, because you want to know how that investment works, you want to know the risk, and you want to know the fees, if there are any that are associated with that particular investment. If you're not sure, you can always contact the OSC. We have a toll-free number, 1-877-785-1555. Now, the other thing I just want to tell you is, I mentioned that if you're working with someone for investing, you should always check registration. So how would you check registration of an individual? Two ways. Visit checkbeforeyouinvest.ca, or you can call the OSC, our contact center. We have a team of people that will be more than happy to check registration for you. Registration will protect you from unqualified or fraudulent individuals, because registration tells you what that person, what services that individual can provide you. It also tells you that, if they're registered to provide that particular service, that particular product, that they have the skills, the qualification, and the background knowledge to give you that. So it's really important to check registration if you are working with any individual who's helping you manage your investments. And lastly, what do you do if you suspect that you have been the victim of a scam? Now that I've shared some of these scams with you, report it. By reporting it, you may prevent someone else from becoming a victim. You can contact the OSC, you can contact the Canadian Anti-Fraud Center, or you can contact your local police. What's really important is you report it. If you report something to the Ontario Securities Commission, and it's not something we investigate, because we wouldn't investigate breaches of the Securities Act, so likely related to investment fraud. If you report something to us and it doesn't fall under our jurisdiction, we can still share that information with the appropriate law enforcement agency or appropriate government agency. Similarly, you report something to the police, it's not something they investigate, they can share it with the appropriate agency, the appropriate authorities that would investigate. What's important is to report it. So that said, this now concludes the fraud section of my presentation, and I'm going to turn it over to Michael to continue the presentation. Thanks, Michael, over to you.
Thanks, Christine. Great job. That was a fantastic overview of not only the types of frauds, but also some of the ones we're actually seeing right now. So hopefully everyone has a good sense of the types of frauds and the things to watch out for and what to do if you suspect a fraud. So I'm Mike Tracy. I'm the Manager of Investor Research and Behavioral Insights at the OSC. And what I want to talk to you about is really the ways in which the way in which we make decisions can lead us towards falling victim to frauds and scams. So one of my areas of expertise is behavioral economics, and we're going to talk a little bit about how behavioral economics can both lead you to fall victim to a fraud or a scam, but also how we at the OSC are using behavioral economics to help protect investors. But before we get into all that, we're here talking about investing. So let's do a little example of an investment decision that people are presented with typically all the time. So what you have in front of you here is a series of potential investments, potential mutual funds that you could buy. So you have Power Trade Investments here in orange, you have Fortitude here in purple, Alpha in red, Tobacco Trade in green, and then the S&P 500. This is just an index of what the market was doing at the time. So you have 5 years of performance data here. So go ahead and look at how each of the funds has done over time, and pick out the fund that you would invest in if you had to make an investment decision right now. I'll give you a few seconds to go ahead and look through that. If you have a pen and paper, maybe write down the name of the one that you've decided to invest in. I'll give you a second. So unfortunately, I can't see you, and I would typically do the show of hands to see where everyone is. But typically when we do this, what we see is a lot of people choosing either power trade, because it's the one that has made the most amount of money. It's a little bit volatile, but it's definitely the most profitable one. We also see the majority of people, the overwhelming majority, pick Fortitude. It's a nice stable investment. So maybe that was the one you chose. And then after that, we do see some people taking Alpha. So it's not the highest performing one, but it's got some volatility in it. That's kind of what you would expect to see in a typical performing fund. So those are kind of the three main ones people pick. And Fortitude is usually the winner. So if you chose Fortitude, I would like to congratulate you, but unfortunately I can't, because Fortitude and the data that we use to generate this line is actually data from a Ponzi scheme. It's data from Bernie Madoff's Ponzi scheme, in fact, which was one of the largest ones that's ever existed. So if I showed the next time period, you would see that this fund drops down to zero as the fund collapses, which is exactly how Chris described a Ponzi scheme earlier, is that it works and gives, consistent returns up until the point that it fails. And that's essentially what happens here. So looking at how a stock has performed over time, its history is very tempting to say, oh, good, it's got nice stable growth. That's what I want. But you always have to do those things Chris told you about, which is really thinking through investment decisions before you make them. But what makes it so that we fall for things like this? Why is it that that we see things like Fortitude and decide that's where we want to go? And that's really where sort of behavioral economics comes into it, because it's not always that we're making rational decisions. And before I get into that, we're talking about older investors and how we're protecting older investors. Now, generally, these things are actually important to all investors, but there is a special focus that's often required. And one of the main reasons that we're interested in older investors is really this chart here, which comes from some research that was done, which looked at people's financial literacy and how well they understood their finances over time. So you have at the bottom here their age from 60 to 90, and these purple boxes show their level of financial literacy. So you can see a pretty significant decline as people move from 60 down to being 90. But what you don't really see is a decrease in their confidence. So how well they think they understand their finances remains pretty constant across time. So what you end up getting is this blue line, which is really people who are overconfident in their abilities, which makes them more susceptible to frauds and scams. So that's one of the reasons in which older investors kind of require special interest from us. And what we're doing at the OSC is we're really looking at vulnerability as a key part of people's investing experience. And as people become vulnerable, they become more susceptible. So the natural aging process, of course, brings some of this, but it's not guaranteed. People, of course, can remain fully capable as they move into their older years, into their 90s, even into the triple digits. People can remain fully effective at making decisions. But there are certain things that do become more prevalent as people age, and that's kind of what we're doing here. We're looking at the probability of these things. So some of the vulnerabilities that emerge are physical ones, mobility limitations being a big one, hearing deficiency being another one. Some of them are cognitive, so executive dysfunction, so your ability to make those higher order decisions becomes more challenging. Memory loss, of course, is a big one, where sometimes a fraudster would prey on that. They'd say, no, we talked about this last week. And if you suffer from memory loss, you may not remember that you didn't have that conversation. Another big one is what we call information overload, which is where you present someone with so many options that they just can't pick. So actually, what I just showed you earlier when you were picking your fund, that may have been information overload. To see those 5 line graphs, they're all intersecting. It's very confusing as to what's actually being shown. So that's an example of information overload. In the real world, that's often even higher, where you'll see, you'll have the option of 20, 30, 40, 50 different funds. And it becomes quite hard to determine which ones are the right ones for you. The other one is emotional. So these can be more volatile. So whereas, declines in your cognitive ability are sort of consistent, you may get a decline over time. Emotions can ebb and flow, and really depression, anxiety, loneliness, as examples, can all lead to different decision making, and they can be a little more sporadic than your typical decline in cognitive functioning. Another one is social, really important. So like social isolation makes people more vulnerable, or an overly large reliance on one person, particularly if that person isn't someone who you can fully trust. And of course, a desire for independence. Sometimes a fraudster can prey on that. The last one is societal, where someone becomes more vulnerable because they have a lot of wealth. So, think of the wealthy widow as a classic example, where, a young suitor comes along trying to take her money away from her, as a bit of a trope, but certainly an example that is real. Marketing tactics that prey on people. And then, of course, the concept of stereotype threat becomes a little bit important as well. So the big thing about all of these is that although they can relate to age, they're not exclusively limited to people who are older. So what I really want to underscore here is this: financial vulnerability at any age is important. People can become financially vulnerable at any point in time. One that we didn't include here, but that's also important, is things like intoxication or use of cannabis, where you're vulnerable for a very short window of time because you've had too many glasses of wine or used cannabis. So another example of vulnerability that is important. So we've kind of covered that, who can be vulnerable, and the answer is really anybody. And let's start to talk about why it kind of matters. We had the example where you potentially invested in a Ponzi scheme, and what sort of leads people to making these ultimately bad decisions. In the example of the Ponzi scheme, you could have, if you had time to do your research, you would have looked and said, it's actually almost impossible for an investment fund to have no relationship with the average market returns. That S&P 500 line that was on there, they should have been somewhat correlated with each other, and they were not at all. That's a great indicator that something's a Ponzi scheme. You didn't have the time to do it, so you had to make a decision. And this is where behavioral economics comes in. What do people do when they don't have all the time and information? And we call this concept bounded rationality. So you were under a time constraint, and you also didn't have all the information you might have needed. If you had the time, you might have went and looked and saw that the correlation between market conditions is really important. And that would have helped you make a better decision. But unfortunately, you didn't have that time. You had to make a decision. And that's why when Chris talks about those high pressure sales tactics, that's why they use them, because they know they can put this condition of bounded rationality on you that makes it a lot more likely for you to make a mistake in your decision making. So when people are constrained by time and information, they have to make a decision, and they don't have time to get out their pen and paper and calculator and make the best decision. They have to use something else to make a decision. And we call these decision-making heuristics. And these are really shortcuts that people will use. So instead of actually figuring out the full problem, they'll just use some type of shortcut in their mind to make the decision. So an example of one of these decision-making heuristics is what we call the availability heuristic. And this is where, instead of thinking about all the information that's important, you think about certain pieces of information that are more readily available in your mind. So in the example of the Bernie Madoff scheme that I had you all potentially invest in earlier, that nice stable line is very salient, right? And it's like, oh, low volatility, I like that. That is then overweighted in your decision. And when that happens, that's what we call a cognitive bias. So this is essentially when you're making a judgment or a decision in your mind, you overweight certain pieces of information. And in the case of the example I showed you earlier, the lack of volatility was probably overweighted in your decision. You liked that too much, essentially. So another kind of example of this decision-making heuristic, not in the investing world, but something that I hope will drive home the point as to what it really is imagine you're someone who's deciding whether it's safe to go for a swim. And there's a lot of data that you could look at before you decide to jump in the water, but you're of course not going to look at it all. You could look at weather conditions, aquatic life, your knowledge of how good of a swimmer you are, if there's a lifeguard present, what the daily conditions are, is there a riptide? Like there's all these sorts of things you could ask yourself, but people typically don't. But perhaps you just watched the movie Jaws before you decided to head to the beach. Well, now the prospect of a shark attack becomes very salient in your mind, and that availability heuristic kicks in, and you think, well, the chance of a shark attack is really high because I just saw a movie where there was shark attacks. So then the bias plays into effect, and you decide it's not safe to go for a swim. That's an example of sort of the process, right? You have that constraint, you have to use a shortcut of some kind, and it leads to some form of biased decision making. So a lot of these biases have names. I just shared with you availability and how it can manifest as a bias. But when it comes to investment decision making, there's four that I really want to flag for you because they really play a key role in frauds and scams. So the first one is what we call optimism bias. And this is the tendency for people to underestimate the likelihood of negative events or to overestimate the likelihood of positive events. So if a fraudster tells you something's too good to be true, your optimism bias is going to kick in and lead you to believe that maybe they are telling you the truth. The next one that I want to flag is what we call choice supportive bias. So this is basically where once you've made a decision, you tend to want to stick with that decision and you won't change your mind very easily. Think of this as sort of like the concept of inertia from physics. What we basically have is if you decide to invest in something, say a Ponzi scheme, and you're getting good returns, well, now choice supportive bias kicks in and you keep saying, well, I'm going to continue to invest in this fund instead of stopping to think and say, hey, you know what, I've made a bunch of money. Maybe I should pull my money out and invest in something that's a little more safe. The next one is illusory superiority. So this is where a person sort of overestimates their qualities in relationship to the same qualities in other people. So someone might think to themselves, you know, other investors will fall for scams, not me, right? I'm better than other investors, so I won't fall for scams. But as Chris said, everyone gets approached. And as I just pointed out earlier, everybody can be vulnerable. So it can really happen to anybody. And this illusory superiority bias is a really detrimental thing to your investment life. The last one I want to talk about is illusion of control. And this is a tendency for people to overestimate their ability or control events that are otherwise really random. So, you know, there was a lot of really smart people that invested in Bernie Madoff's Ponzi scheme. They thought that it was within their control. They're like, I know what a good investment looks like, and I can control the ones that I invest in. Therefore, I will never invest in a fraud. And they invested in one of the biggest frauds of all time. So when something's random, you have very little to no control over it. And one that I really want to flag for people is basically cognitive decline. There are certain factors, if you get into the medical research on what might lead someone to experiencing cognitive decline more than someone else. But for the most part, it's probably best to think of it as a random negative thing that can happen to you. And if it does happen to you, it can have a big impact on your financial life. So it's important to kind of prepare for these things and not imagine that you can control the likelihood of something happening. And this really leads me to, oh, sorry, there's one more slide before I get into my next bit. So essentially, I've kind of gone through sort of the behavioral economics and the problems that can emerge. But the nice thing about behavioral economics and an understanding of these heuristics and biases is that people make mistakes, but they always make the mistakes in the same direction. So they're not just random errors in decision making, they're consistent and always the same way. So as a result, we can leverage those errors in decision making and ultimately use them to help protect people. So this is a process, we call it the behavioral insights process, and we use it to make policy at the OSC. And what I want to flag for you, I'm just going to bring all my little graphics up, is it's a policymaking process that relies on the insights from behavioral economics, behavioral science. And it's an inductive approach. So this means that we don't really make assumptions about how people are going to behave. We actually just look at how they're behaving in the real world. And then we use that to inform our policymaking. And then whenever possible in this approach, we try and run experiments. So it's become more of a topic of conversation, usually as a result of COVID-19, but the ways in which they determine if a vaccine is effective is the same way we determine if a policy is effective. So we use a randomized controlled trial, and we basically give different groups different treatments, and some essentially get a placebo. And we determine if our policy is going to have a positive or negative effect on people's experiences. And the last thing I want to talk about is that this really is focused on human decision making. So in traditional policy, we like to use economics as our sort of foundation, right? Which is that people are hyper rational. They try and maximize their utility, which is essentially their happiness. And they're really consistent in their preferences. So if somebody prefers apples to oranges, they're always going to pick apples over oranges. So what we do is we lessen that and we say, you know what, sometimes people are going to choose oranges over apples, even if they like apples more. So people are not always consistent. They're not always hyper rational. So that's one of the key ways in which this differs from traditional public policy making. So the OSC has taken a keen interest in protecting Ontario seniors, and we've laid out sort of our vision for the future of seniors in Ontario participating in the capital markets in our senior strategy. It's OSC Staff Notice 11779 if you want to go look at the document. But one of the key parts of this document was really that we wanted to develop a framework to help address issues of financial exploitation and cognitive impairment among older investors. So really, this was a project where we wanted to try and reduce the risk of financial exploitation due to an illness, impairment, disability, or the natural aging process. And we also wanted to protect clients who are showing signs of diminished mental capacity. So these are kind of who we're trying to protect. You'll note that there really is no strict age requirement because, as I mentioned earlier, anyone can become vulnerable at any point in time for any number of reasons. And we're trying to protect as many investors as possible. So one of the key components of this is what we're calling the trusted contact person. So this is where an investor would basically identify someone that they know to be their trusted contact person. They would give that person's name and information to their advisor or their dealer. And that person then becomes someone that their dealer or advisor can reach out to if they have concerns about the potential for financial exploitation or diminished mental capacity. So the idea here is that firms will have to ask their clients if they can provide a TCP, but they will not have to provide that trusted contact person, the clients, but they do have to ask. So the way to kind of think of this is, a client goes to their advisor and says, I would like to liquidate all my money and I would like a check, cash for all my assets. That person would say, okay, well, the dealer would go, that's out of the usual. I'm going to contact a trusted contact person to see if anything has changed in their life. And maybe that trusted contact person, a friend, son, daughter, spouse might say, oh yes, my whoever has recently experienced this trauma and is making not good decisions. So essentially, if that is the case, the TCP has no actual power to do anything. They can only provide information, but the dealer can then put a temporary hold on the account to protect that person's money because they may be taking that cash to give it to someone who's trying to scam them. So we talked about the fact that this is something we're doing to protect investors. And we really think a trusted contact person is going to be key in helping to protect older investors from financial exploitation or if there's concerns about diminished mental capacity. But as we said, or as I said earlier, this is something that firms are going to have to ask people for, but people are not going to be required to provide it. And in other jurisdictions with similar policies, we've actually found that very few people are providing this information to their advisor or dealer. So what we wanted to do in the investor office on the research team was come up with a way to use behavioral economics to make this more effective, to get more people protected by having a TCP. So I'm not going to bury the lead. Through this project, we were able to find a way to increase the number of people who would appoint a TCP by 23%. So that's a big jump in the number of people who are going to be protected by this policy through using some little techniques from behavioral economics to nudge people in the right direction. So I mentioned earlier that the traditional way of looking at something is from the perspective of economics and hyper-rationality. So let's look at the decision to appoint a TCP from that perspective. So let's take an investor who had a salary of $75,000 a year and has accrued over their working life $1 million in assets. And then let's say that the risk of them experiencing a vulnerability-based loss, so basically a fraud or a scam due to financial exploitation in some capacity or diminished mental capacity, is 0.0000005%. And let's assume that the time to provide the TCP information is 10 minutes. So I think this number is actually quite low, and the 10-minute number is also quite high. So we're being very conservative in our estimates. But even given all of this, what the expected benefit to that person would be is $50, right? And the cost would be $6.25. So it's an absolute no-brainer, even from strict economic rationality, not taking into account that if you do fall victim and you lose your $1 million in assets, you're going to have to really struggle to survive. But even just from a strict economic rationality standpoint, good decision. But for whatever reason, no one's appointing a TCP. So let's look at that decision and kind of break it down into its constituent parts. So really the first part when you're asked to provide a TCP is that you need to understand what's being asked of you, right? And why it's being asked of you. And here the challenge could be that someone doesn't have the financial literacy to understand why it's important. They may already be experiencing some cognitive decline and not understand why it's important. Or they may be biased in some way, as we mentioned earlier. But let's get past part one. So someone understands the decision to be made. Now they have to get into part two, which is evaluating if it's good for them or bad for them. And here's where those biases come in, right? Illusory superiority, optimism bias. I don't need a TCP, someone else does, makes sense for them, but not for me. And then the last part is really taking action. So let's say you understand it, you've decided you want it. Well, deciding you want it and actually having it aren't the same thing. You have to actually follow through and work with your advisor to appoint a TCP. So that's the last step. And really at any point along the way, someone can basically fall off and not appoint that TCP. So what we did was we actually looked at how people get asked to appoint. And what we found was most firms are just presenting someone with a form saying, would you like to sign and provide a TCP? So we made some slight tweaks to that form. And what we found was that the number of people who were willing to appoint jumped from 48% in our placebo group, our control group, to 60% in our treatment group that received the best treatment. So that's that 23% increase in number of people appointing. This was done in an online experiment. So I actually think that in the real world, these numbers will be higher as there becomes more money on the line. People will care a little more. But from an experimental standpoint, this is a huge jump in the number of people who will be protected by appointing a TCP. The other thing we wanted to do with this was see if we could actually debias people. So people had optimism bias. We wanted to see if we could reduce that optimism bias. And actually, we were also able to achieve that. So this, again, was our control group where people thought bad things were 14% less likely to happen to them than they were to happen to someone else like them. Well, this number dropped down to 11% for the group that saw our best treatment. So again, the ability to debias seemed to be an important reason for why people were more likely to appoint that trusted contact person. This may not seem huge, but again, if you're doing it across the entire population, that reduction in a little over 3% is actually quite meaningful. So the last thing I kind of want to finish on with the trusted contact person is that this is something that's hopefully coming. So firms aren't required to ask you yet, but we're hoping that it will become a requirement very soon. There's work going on at the OSC and with our colleagues at the CSA to make this become a requirement. So hopefully that's the case soon. And if it does become a requirement, maybe we'll be able to come back and speak to you in more detail about the trusted contact person. But I would say there's nothing preventing firms from asking. So some firms have already started asking for this information, and you may have already been asked to provide a TCP by your firm. So again, it's optional. You don't have to have one. I think the benefit dramatically outweighs the costs, but it is up to you. But I would say that it does provide some peace of mind if there is an emergency, right? Again, it's nice to think that we're always going to remain fully ourselves and never become vulnerable. But you don't want to wait until it's too late to have protections like this in place, essentially, because again, the cost is very low. Again, now when it comes to who, I think we're going to be providing a lot more detail on this over the next several months from the OSC, but really a trusted contact person needs to be exactly that, someone that you trust, someone that's mature and can handle the difficult conversations about your situation. And the last thing I just want to really stress about this is that a trusted contact person does not have the ability to make decisions on your behalf. They are an information source for your dealer or advisor. So you're not giving up any of your own agency to appoint a trusted contact person. And with that, oh, look at that. We did really well on time. So I'm more than happy, and so is Chris. I don't know, Chris, if you want to jump back on screen to answer any questions that you may have about fraud, scams, behavioral economics, the trusted contact person, or anything else that we can talk about.
Wanted to say thank you. Thank you so much, Michael and Christine. A lot of information and a lot of really important insights presented in both of your talks today. I do want to open up our Q&A session right now. And so please feel free to, sorry, I'm having a little bit of trouble with sound on this end, but please feel free to enter any questions you have for Michael or Christine into the chat box. We do have a question. I'll start off with what we have already. And I'm not sure if this is for Chris or Michael, but a question is, what recourse do you have if TCP, the trusted contact person, turns out to be less than trustworthy?
I can take that one. So again, the first thing I would say is they don't actually have the ability to make decisions on your behalf. So they can't do anything to get your money or anything like that. So there are other positions that you can appoint people to where they do have some power. So power of attorney being a big one, right? So if you appoint someone as your power of attorney, they actually have some power over your affairs. A trusted contact person is not that. So the ability for them to do any harm or damage to you is actually quite low. The other thing I would say is that if someone becomes what you believe to be not trustworthy, removing them is very simple. You contact your dealer and advisor and say, I no longer want person A to be my trusted contact person. After that, if you believe that they are trying to financially exploit you, then it needs to be reported. And maybe Chris can speak a little bit to how that should be reported. But again, if that's what you believe, it's definitely something you should report.
Michael, we're also hearing a lot about abuse in terms of possibly having a power of attorney who may turn out to actually, not be as trusted as the person who intended to put them as power of attorney turns out to be. Is the person who's a trusted contact person, would they have to be someone separate from a power of attorney? It seems like you would have two separate people. Is one really providing oversight over the power of attorney, or even vice versa, the other way around?
No, and this is something we're looking at in the guidance is, should your TCP be different than your power of attorney? I don't think we've settled on what the answer to that question should be. I think it will be very much case by case. If you have two people in your life that you trust that much, very lucky for you. And I think it's good to probably have different people. But if that's, something we would expect as almost, part of the rule, I don't think we've reached that decision yet. But again, the TCP is not really related to the power of attorney in any way, right? There's no designed interaction between those two things. It's really, it's a separate concept and it's a separate function. And really that function has one role, which is to provide information to your dealer advisor if they suspect financial exploitation or diminished mental capacity.
There's a question here. Why would you not give the TCP the agency to decide for you if faculties are declining and you think role needs broadening? They think the role may need broadening. This is a comment in terms of broadening the role of the trusted contact person. Otherwise, where would the protection be?
Yeah, so the protection really comes from your firm, right? So it was the one part I mentioned was that your firm has the ability to put holds. And I didn't go into tremendous detail on this because I wanted to focus on the TCP, but essentially what a hold gives the firm the ability to do is do their own investigation, right? And determine if the transaction is legitimate or potentially fraudulent. And that's really where the protection comes from in terms of the trusted contact person. And again, we wanted to keep the scope narrow, right? We didn't want to muddy the waters between how they relate to a power of attorney or anything else that might be appointed to help protect someone if they experience cognitive decline to the point where they need someone else to make their decisions for them.
Thank you. We still do have a few minutes. If anyone has any additional questions, please feel free to enter them into the chat box for Michael or Christine. There is a question here asking, could you share the presentation or PowerPoint? We are recording today's session, which will be sent out to all the attendees. But unfortunately, I believe the presentation itself as a PowerPoint slide deck, we're not able to share that, but you will receive a recording of today's session 24 to 48 hours later. Michael, sorry, did you have something to add to that?
Yeah, I was just going to say, I don't think Chris or I gave the disclaimer that we're really speaking on behalf of ourselves and not the OSC as an organization. So good that we got to get this in there now. I know someone gave it from Ryerson's standpoint, but just to reiterate that from Chris and my standpoint, it's helpful. But yeah, unfortunately, we're not able to fully share this slide deck.
Thank you. Let's see here. I think we have just a couple more. Okay. Comments. Thank you for a very informative presentation. And let's see if and also, that's it. Michael and Christine, I don't know if you have anything else that you would like to add. I think it was an incredibly informative presentation, a lot of information here. And as mentioned, we are going to be be sharing the recording of today's session with each of our participants. And I think, I won't say anything else. So I think at this point, we want to say thank you, first of all, to Christine Allam and to Michael Tracy for the presentation today. And also want to say thank you to everyone for attending today's workshop. I'm sure some of you are planning to attend some of our other workshops that we are offering. We do have additional events coming up for June, and then we will be taking a break for July and August and coming back with a full schedule for September as we begin the new fall academic year. So we really encourage you to check out our website, Programs for 50 Plus. It'll be entered into the comment box as well. And then if you have any questions, please also feel free to contact us by email, programs for 50 plus at ryerson.ca. That'll be entered into the chat box as well. So if you have any additional questions that you may have for Christine or Michael, please do feel free to email us as well. The contact information will be entered into the panel box as mentioned. We are going to be sending out a survey as well within 24 to 48 hours, as well as the recording of today's session for you. And on behalf of the Chang School at Ryerson University and our presenters today, Christine Allam and Michael Tracy, we want to say thank you so much for joining us today, and we hope you'll have a great rest of your day. Thank you, everyone. Thank you, Christine, and thank you, Michael.
Thank you.
Thank you. Thanks for having us.
Okay, bye-bye.